During the previous week, volatile conditions prevailed in the spot and forward markets. Rupee registered a low and high of 74.32 and 73.50 on Monday and Friday last week. In April 2021, the BSE Sensex registered a fall of 2.49%, the worst performer among Asian stocks after the 3.5% slide in Nikkei 225. Taiwan weighted index was the best performer with a gain of 6.01% in April. After an average monthly inflow of USD 2.55 billion into Indian equities by foreign investors in January to March 2021, the equity flows turned negative at about USD 2.15 billion during the period from the beginning of April till Friday last week. In April 2021, the dollar index fell by 2.07%, which led to an appreciation in euro and pound by about 2.50% in the corresponding period. After euro touched a 2-month high of 1.2177 on Friday, the single currency is currently trading at 1.2155 as the euro is more sensitive to European economic outlook. National lockdown measures are not on the way, but the states have already imposed lockdown measures to contain the surging coronavirus cases that have overwhelmed the healthcare system. The COVID-19 task force has already advised the federal government to impose a national lockdown. The government is at present not favoring complete lockdown as it would curtail economic activity almost similar to a fall in economic output by 24% in April-June 2020. The fears of a national lockdown have already raised concerns, and the domestic currency and stocks have not yet negatively reacted to the possible adverse events. Due to thin market conditions and lack of dollar buying interest in the market, the rupee has strengthened. The huge dollar selling interest from exporters and IT companies facilitated the rupee's uptrend to continue for some time. The depreciation in the forward rupee for 3 to 6 month maturities encouraged the above entities to sell their forward dollars to obtain a favorable exchange rate in those maturities. In the absence of portfolio inflows and other FDI inflows, it is hard to imagine the sustainability of the rupee's rise beyond the 73.30 level over the short term. The rupee maintained its firm trend backed by the higher forward dollar premium levels prevailing in the market and foreign fund inflows into Indian companies. In fact, the appreciation in the spot rupee is almost neutralized by the sharp depreciation being observed in the forward rupee up to 3 month maturities. COVID-induced lockdowns in most of the states have pushed India's unemployment rate to 7.57% in April as compared with 6.52% in January 2021. This data has been compiled from the purview of job losses suffered in the organized sector. The significant fall in forward dollar premia in maturities up to 3 months as a result of the PSU bank receiving in near-term forward has not resulted in the rupee's decline, but instead it started to appreciate. Many of the market participants still believe the domestic currency to gradually decline and test the 74.80 level before the end of this month due to foreign fund outflows and discouraging outlook on the domestic economy. As long as the government has an aggressive borrowing program, the rupee shall remain weak, though its current situation seems to be only temporary. To boost export growth and keep the trade deficit lower, the central bank may wish to hold the rupee weaker at close to the 75 level. When the rupee touched the low of 75.32 on 22nd April 2021, RBI's intervention to sell dollars was passive in nature, as the sell-side dollar intervention would suck rupees out of the system. With the steep rise in daily cases of over 400,000 cases in 4 consecutive days in the last week, the uptrend in the rupee seems to be not justified in the current circumstances amid the foreign fund outflows and growing negative sentiment in the economy. The GDP growth outlook is already being revised downward to a single-digit growth by money rating and multilateral agencies. In the current circumstances, we feel the rupee exchange rate is delinked from economic realities. The ballooning fiscal deficit and discouraging growth outlook amidst inflation fears may at some point of time reverse the domestic currency uptrend for a possible down move to 74.80 levels in the next 1 month period. The corporate forex risk managers are in a dilemma on the approach to be followed in hedging their revenue exposures, as the volatilities in the spot and forward markets are ruling high. It is imperative for the corporates having huge forex exposures to refix the internal benchmark rate and or guidance rate for each item of exposure to help manage the foreign exchange exposures efficiently.